Interest rates are on the rise. The average 30-year fixed mortgage rate has nearly doubled over the past year, shooting up over 6%. Credit cards, auto loans, and other borrowing costs are climbing too. In this high-interest environment, consumers need to rethink major purchases that once seemed affordable, but now can wreck their finances. Let's explore some of the worst money moves to avoid when rates are high. Mistake number 1. An expensive new car. With interest rates low, those $500 to $600 monthly payments on a new ride may have tempted some. However, according to Kelley Blue Book, the average new car transaction price just hit a record high of over $48,000. Therefore, now loaded down with high-interest auto loans, many borrowers regret overspending on depreciating assets. Opt for a used car you can buy outright or make a large down payment on. Look for certified pre-owned models that offer warranties and peace of mind. Additionally, an older used car with good reliability ratings can also get you from A to B without breaking the bank. Plus, calculate total costs including insurance, gas, and maintenance. Expensive cars cost more to own overall. Mistake number 2. A lavish dream home. When mortgage rates dropped below 3%, many stretched their budgets to buy bigger homes. Nonetheless, research shows over 50% of first-time home buyers now regret overspending. As rates pass 6%, larger mortgages can consume 60 to 70% of your take-home pay. Consider downsizing your home dreams to a more affordable option. To avoid being house poor, make sure your total monthly housing costs, including mortgage, insurance, taxes, and utilities, account for no more than 28% of your gross monthly income. Also, get creative and look at condos, townhomes, or homes that need some TLC that you can remodel over time. Plus, moving to a location with a lower cost of living could also allow affording your dream home eventually. Mistake number 3. Financing big splurges. A NerdWallet survey reveals 33% of Americans are currently financing discretionary purchases like furniture, electronics, vacations, and more. However, as interest rates rise, financing large splurges with loans or credit cards gets very expensive. Save to buy major wants in cash. Additionally, carefully consider needs versus wants. Maybe skip the jet ski and invest the money instead is a better idea for you in the long run. If you do decide to finance, shop around thoroughly for the lowest rate and best terms. Also, consider using buy now, pay later plans, which offer interest-free installments. And be sure to make payments on time to avoid deferred interest being added. But before you decide to buy something you really want, consider this wise advice Warren Buffett once said: "If you buy things you do not need, soon you will have to sell things you need." That's why you should avoid debt by sticking to needs and delay big purchases until you can comfortably afford it. Mistake number 4. Racking up credit card. Debt with interest rates increasing, credit card debt is much pricier to carry. Yet Experian reports the average credit card balance is still $5,343. At a 20% interest rate, that's over $1,000 a year in interest. Live within your means, pay off cards monthly, transfer high-rate balances to lower-rate cards. Just don't let balances linger. Furthermore, review statements regularly and pay attention to when lower introductory rates expire. Also, automate payments to avoid late fees or lapse in payment that incur interest. It is recommended to build an emergency fund so you don't need to rely on credit cards to cover unexpected expenses. Also, be cautious of retail credit cards that offer discounts but charge very high interest rates. The discounts can sound appealing, but don't be fooled. Mistake number 5. Paying student loans slowly. In the 2022 to 2023 academic year, federal student loans for undergraduates carry an interest rate of 4.99%, while graduate students face interest rates of 6.54% for unsubsidized loans and 7.54% for direct plus loans. Therefore, those paying loans slowly will feel it. Make accelerating principal payoff a top priority. Additionally, trim expenses elsewhere to put any extra towards high-interest student debt. Don't prolong repayment. Knock them out fast. Also, explore income-driven repayment plans that base your payment on what you can afford. This can potentially lower payments while still chipping away at principal. In this rising rate environment, individuals need fiscal discipline more than ever. Let these common but costly mistakes serve as a lesson. Avoid overspending and high-interest debt. Invest wisely and responsibly. With smart financial habits, you can master your money even when rates rise. If you enjoyed this video, please hit the like button and subscribe to my channel for more money tips. Thanks for watching, and remember to spend smart during high interest rates.